Hello, good morning. My name's Arthur Deakin, and I'm the co-director of energy at America's Market Intelligence. Today, I'll be presenting on how IOCs, international oil companies, can contribute to a net zero economy in Latin America. So if we move forward, this is just our legal notice. A little bit about AMI. What we do is provide market intelligence to different clients, energy companies, investors, service providers looking to develop energy projects in the region. We provide market intelligence through interviews, through research, through analysis to help them have successful client engagements in the region. Essentially, what we do is we help our clients effectively compete in Latin America's energy sector. So getting into the bulk of the presentation. Everyone's talking about net zero. Everyone's talking about how to adapt to this new reality in which we have to reduce our carbon emissions. And of course, international oil companies, IOCs, are a big part of this transition, whether we like it or not. They're going to be very important. They're going to contribute excessively in terms of how much money is spent in this transition. They're going to be involved in a very pioneering type projects in terms of carbon capture. They're going to be focused on R&D that's going to help us move forward. So they're a very fundamental part of this energy transition. What I want to focus on is their role in Latin America. So IOCs, some of them might be looking at this as a challenge, an obstacle, and indeed it is, but there's also a lot of opportunities that can come out of this energy transition. And we believe that finding cleaner fossil fuel opportunities, so assets that have lower emissions when extracting, when refining, while also investing in renewable energy and carbon capture, storage utilization technologies is the most profitable way forward for IOCs in Latin America. As we see here in the chart to the left, there's still a big gap between what is being spent in the energy transition and what has to be spent. Almost a tripling of size when we compare the spend of 2016 through 2020 and what's needed to reach sustainable development goals between 2026 and 2030. And most of these investments, or the largest proportion of these investments, are going to be in end use sector. So that means establishing electric vehicle stations, hydrogen refueling stations, retrofitting buildings, decarbonizing heavy industry, and IOCs all have an important part to play in this part, the end use sector, especially when it comes to electric vehicles. We think that there's a lot of synergy that can be taken advantage of here. So oil super majors, as we all know, are very well capitalized. They have strong balance sheets and large capex. This allows them to develop more complex projects when compared to competitors with cheaper capital and with fewer financial commitments. So big oil, IOCs, has an opportunity to use this capital to their advantage. They also have the opportunity to use existing expertise. We see Exxon and Chevron using their experience with horizontal drilling in the US Permian Basin to capitalize on geothermal opportunities elsewhere. We've seen other oil companies use their offshore drilling expertise to develop offshore wind farms. So that's something that we see as cost efficiencies for IOCs. And then one thing that is not being discussed as much is the vertical integration that's presenting itself. So IOCs have done this very well in terms of upstream, midstream, and downstream in the oil and gas sector, but we haven't seen this in the renewable power generation and transmission and distribution space. I believe there's more of an opportunity to get involved in this mid and downstream parts of the business, developing, decentralizing the grid, building out smart meters, developing transmission lines. And I know this is not the IOC's bread and butter, but through strategic acquisitions, I believe that they can green a large part of their supply chain and find operational efficiencies and profits along the way. So That's something to be considered. Carbon capture technologies are also should be implemented with power generation, whether it's natural gas, whether it's oil, whether it's coal. And then in the transportation of gas, we also see a lot of room for improvement with leak detection and repair programs. And also the implementation of vapor recovery units. I think that's going to reduce methane leaks significantly in natural gas projects. So if we move ahead, one thing I wanted to note out is the high energy prices that we're seeing across the world. And there's a variety of reasons behind this that I'm not going to get into. But in general, high energy prices will help some LATAM economies while it will hurt others. It's going to bring inflation. It's going to require higher government subsidies to reduce the amount spent by consumers. So we did a risk analysis, looking at 12 important LATAM economies to determine the overall impact of high energy prices. And as we see here in the chart, the ones that are going to benefit the most are Guyana and Brazil, followed by Colombia and Costa Rica. Then everyone else after that is either neutral, from Mexico to Panama, and then Argentina, Dominican Republic is negative. You might be asking, why is Argentina negative? Well, they import a lot of natural gas, and prices are rising, which is going to cost them more money, which is going to lead them to have to pay extra in subsidies. But the government has recently made a deal with the IMF where they have to reduce their energy subsidies significantly, which is going to lead them in a very tough spot politically. Do we choose our debt deal with the IMF, or do we choose our political longevity where we continue to subsidize energy prices? Then very negative are Chile and Peru, and the major reason behind that is that they're major importers of oil and gas, so the higher prices will impact their costs, and they also have two presidents recently sworn in that are against further exploration of oil and gas for the most part, and coal, and so that's why there's quite a lot of political risk there, as you can see in pink. So that's overall what we see, the impact of higher energy prices by country. It's something that IOCs have to be aware of, and just governments and companies should be aware of in general as well. So Guyana, why are they at the top? So as I mentioned briefly earlier, they have a very high quality, low emission crude. It's light, it's sweet, it's low sulfur. So it's in very high demand. We've done an analysis of the average greenhouse gas emissions by type of crude. This is using Carnegie Mellon's Oil Climate Index as a reference, but we believe that Guyana's oil found in the Stabroek block, which is the most advanced block, and as well as Suriname's block 58, are going to be in the lower end of the greenhouse gas emissions range. And that's going to make it very appealing for investors and companies looking to continue to provide oil and gas, but reduce their emissions while doing so. So that's why Guyana is top of the list. They also have very low break-even costs. So even though there is this transition away from oil and gas, it's a gradual shift, but eventually there is going to be a peak in oil demand, we believe, in the mid 2030s or early 2030s. Oil and gas companies are naturally going to choose the projects which are more profitable. And that means that those with lower break-even costs are going to be preferred. And that's why we see Guyana, once again, with extremely low break-even costs ranging from $25 to $35 for its first four FPSOs. Suriname a little bit higher at $40, but we expect that price to decline as it gains some cost efficiencies and uses some of the shared infrastructure with Suriname. So low emissions, low break-even costs. This makes Guyana and Suriname to an extent a very appealing opportunity for IOCs. This is just to reiterate what I've been saying. Guyana and Suriname, they're going to produce an estimated 2 million barrels per day by mid 2030 combined. Guyana is going to see a much larger production. 1.4 million barrels is our estimate, and that's greater than a lot of important countries such as Angola, the UK, Oman, India, Indonesia, etc. They're actually going to be the 17th largest oil producer in the world once they reach that 1.4 million barrels per day. Suriname will also do fairly well at 650,000 barrels per day, but they're still very early in their exploration stage, and they only expect first oil to start flowing in 2025. So this is just something to keep in mind as IOCs look to invest in different jurisdictions in Latin America. Finally, for Guyana, we did a opportunity relative to risk analysis to determine how risky is the oil and gas sector. And our analysis, based on 10 different risk categories, ranging from operational risk to transition risk, determined oil and gas to be low to medium risk. And then we use Suriname as another frontier market to serve as a comparison, and that came out as medium to high risk. And the reason why Suriname is much higher is because it has an unstable currency, inflation, it has debt levels that are unsustainable, even though they've recently signed a deal with the IMF. They've had a long history of corruption and mismanagement in the government, and it's relatively unproven in terms of oil and gas discovery. It's still relatively green, so we determine it to be quite risky. But when we look at oil and gas sector in Guyana, they don't have a lot of these problems. Of course, they have some political risk, some corruption risk, but their biggest challenges are the lack of human capital, the lack of local companies that have experience in the sector, and that are able to provide the scale and expertise to help IOCs develop their oil and gas projects in the country. This does not mean that they're not willing or that it's not being developed, and a local content policy has been passed at the end of 2021 and is already in place. So that should improve the local capacity. But as a company that helps foreign investors, foreign companies go into Latin America and mitigate risk, this is just something we wanted to point out. So transition risk is something that is what we deemed the risk that oil and gas sector will face because of this net zero transition, right? And what we see is that it can be reduced. The risk can be reduced through investments in technology, both from the public and private sector, and also friendly regulatory frameworks that attract certain types of investments, such as carbon capture, such as development of natural gas plants with carbon capture tools, development of green hydrogen, etc., blue hydrogen, right, as well. So CCUS is one way to reduce the scope 1 and 2 emissions, which account for about 10 to 20% of oil companies' emissions. But that can also be joined by the elimination of routine flaring, the electrification of its operations, as well as energy efficiency, so using renewable energy to power its FPSOs, for example, vapor recovery units and leak detection, repair programs for its midstream structures and transportation of gas, and then high grading portfolios, which is choosing those assets, those jurisdictions which are less risky, that have cleaner fuel, that have lower break-even costs, and that's where Guyana and Suriname to an extent fall. And then scope 3 emissions, which is actually the large majority of the emissions, which is emissions generated from the use of oil and gas companies' products. The way we see forward of reducing these kinds of emissions is working with the governments to develop a carbon tax and other holistic climate policies that incentivize oil and gas companies to reduce their emissions. We can also see the replacement of heavy fuel oil with lower carbon fuels, cleaner fuels, and hydrogen. We see Petrobras, Brazil's state-owned oil and gas company, transitioning a lot of their refineries to produce renewable diesel, which is something that's we see being in high demand over the next couple of decades. We've done studies, preliminary studies on this, and we believe it's a very good opportunity, not only in Latin America, but in the world. And then also offering carbon credits for forest conservation and other carbon capturing technologies. This is something that the government can do, of course, as well as private organizations in collaboration with the government. If these tools are implemented, I believe the IOCs can greatly mitigate the risk that they face from this transition. And that is our presentation for today. Thank you very much for listening, and please let us know if you have any questions. Take care. Bye-bye.